Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Shut up and take my money.
That is an all-time low.
And the old bear is back.
I'd buy that for $1.
Telling me, dream.
Hello and welcome to another edition of Buy or Sell. I'm your host, Adam Keily, host of Comedian versus Economist podcast and widely regarded as one of the simplest minds in finance. But luckily for us, I'm joined by an expert to educate me and hopefully you on how they're thinking about stocks and the stocks they're thinking about. This, of course, isn't a deep dive though. We've got 10 stocks to rip through, so we'll get started. And today I'm excited to welcome to the studio Ben Richards, investment analyst at Seneca Financial Solutions. Hi, Ben.
Adam, thanks for having me on.
Absolute pleasure. Thank you for joining us. Now, Ben, we're going to kick things off. I just want to get a sense of where your head's at and interested to know what your theme song would be, Ben, if you had to pick a song that best encapsulates your approach to investing.
Yeah, it's a good one.
What's your walkout song? You're entering the stadium.
Well, I think my walkout song, depending on the context, would be different to my investing theme song. So I've long thought about what my walkout song would be, and there's a few good ones. Yeah, I'm just thinking of the darts, the titanium. That's an absolute ripper if you get a chance to watch that. But in terms of investing, I thought The Climb, Miley Cyrus.
The Climb.
Yeah, I think it's, people get too caught up thinking about the end goal and don't focus enough on, the process and how you can get there and how you can enjoy the process and enjoy, the rest of your life and what you actually want to focus your time on in the interim to get towards those goals. So that was one. I also thought I'd throw in a cheeky second, being Opportunity by Pete Murray. I quite like that song, but I also think it reflects my mindset to the current market, which is ripe with opportunities.
That's so glass half full. It's it's always about that opportunity in any market, right? There's always opportunity. So that's awesome. All right, we do have 10 stocks to get through, so let's get started, and we're going to kick it off with GQG Partners, ASX GQG, currently trading at $2.33. GQG doubled their net inflows in 2024 from 10 billion to 20 billion. At this rate, they're going to need to add another couple of Gs for great growth. Where are we at with GQGGG, Ben?
GQG stands for Global Quality Growth. It's a global fund manager. They've got a few key strategies which are focused on global equities, emerging markets, and US and also ex-US. So for those who don't know, fund managers manage large amounts of money on behalf of institutions or high net worth individuals, any kind of organisation. And they essentially collect fees on that money under management. GQG in particular has a strong emphasis on management fees over performance fees. So they just get paid as a percentage of the total assets under management rather than how well they perform. Yeah, GQG is founded by a guy called Rajiv Jain. He's a really switched on, astute investor. He came out of a company called Von Tobel, launched his own thing with GQG. And he's done really well. He's grown the assets under management. As you mentioned, net inflows are going well. It IPO'd a couple of years ago at about $2 per share. It traded a bit below that once the market kind of cooled off in 2022. Then rallied up on some really strong, persistent inflow numbers. And more recently, the stock has sold off a little bit, which we think is a strong buying opportunity at Seneca with myself and Luke. And we look at GQG as it pays you an almost 10% dividend yield. And it's been discarded by the market for whatever reason. There's been a couple of individual stocks they've held which have had some negative publicity. Adani, Novo Nordisk with some weight loss drug trial results. Just way too cheap and still growing strongly. So we think it's a bit misunderstood in the market.
Yeah, cool. So GQG is a buy. Nice one.
I think I'm going to buy it.
Next, we're going to look at Catapult Group International. ASX CAT currently trading at $3.74. Catapult very much seem like they're kings of the castle right now. What's next for Catapult? Buy or sell?
It's a buy as well for us.
Okay.
We do own it in our small companies fund at Seneca. And Catapult's a really interesting technology story where you probably, if you follow the AFL, the NRL, EPL, they've got these GPS trackers in sports bras that the athletes wear, which tells you, how fast they're running, distances, all these kind of analytical tools that coaches can use to enhance the performance of the team.
I need one for my kids.
Well, they did
I
actually.
need to whack one of those on the kids so I know where they are. I keep losing them.
And the pets so they don't run away.
Yeah. There's an untapped, talk about opportunity, Ben. There is untapped potential.
It's just all blue sky, but no, they actually do. They have been growing really strongly, and the market has kind of just started to reward them for that growth as it's kind of turned profitable. And that's the key, really. I mean, we've seen a bunch of these companies that as soon as they inflect profitable and still have good top line growth, which Catapult does have, 20% top line growth, it really re-rates. And although it looks like it has run a little bit, still got these really strong tailwinds behind the professionalisation of college sports, just more money in team sports in general with, streaming rights and gambling and all those kind of things that feed into that ecosystem, as well as women's sport, like we saw the Matildas in the Women's World Cup of, smashing viewership records, and the more eyeballs on that, the more money is flowing around, spent on things like Catapult, which is essentially protecting the most valuable assets in the athletes themselves, who are paid big salaries. So really interesting company.
I actually bought Catapult not this summer, last summer, because I saw it underneath the shirts of the Indian cricket team. And I thought there's a huge audience watching the Indian cricket team. So I bought, that was my thesis, right? The absolute sum total of the thesis for buying Catapult, but it served me well. But then this summer I noticed the Indian cricket team came out and they're all wearing Whoop wristbands, activity tracking wristbands. So I don't know. Hopefully that's not a sell signal.
It's a bit of Peter Lynch research. Go where you're shopping kind of thing.
Yeah. All right. Catapult for you, though, is still a buy at $3.74.
I think I'm going to buy it.
All right. Next, we got Seek Limited, ASX SEK, currently $24.35. Ben, is it time to hide from Seek?
It's time to hide. Maybe if you want a job, I'd be looking at Seek, but I wouldn't be rushing to invest in it. It's the job ads platform. Has been historically dominant market share in Australia, with a bit of offshore growth as well. But a couple of big glaring red flags for me, Adam, is one, the competitive threats. Players like LinkedIn, owned by Microsoft. You don't want to be competing with Microsoft. I think that actually offers a more complete product offering where, it's a bit of social media, it's a bit of resume building, it's a bit of job ads all wrapped into one, and you can kind of just click through in an easy apply all in one. So I think that's a bit of a threat to job ads, and I don't think Seek has the monopoly that a lot of fund managers seem to think they do. And the numbers actually reflect that. So job ads are down, market share is down, and the most recent result was pretty underwhelming. All that on 45 times PE. So if the earnings remain flat, it'll take you 45 years to recoup your investment. Is kind of the way to think about it. The market trades on 18 times PE, so it's a large premium to the market for a business that's going backwards. And we actually also see some governance issues where they manage this venture, essentially a venture capital kind of vehicle on the side where Seek owns the management rights and takes fees off it. And it's just a bit of a strange one that you don't really normally see. So it kind of raises a bit of, governance concern. So all that we think there's a lot better value in other technology names.
Spells trouble for Seek. Okay, Seek is a sell. Next one, big one. It's been in a lot of the news lately. WiseTech Global, ASX WTC, currently trading at $94.55. Well, that's changing by the day at the moment as we record on the 26th of Feb. 4 board of directors, including the chair, have up and left. Without a chair, they're looking at the bench. Ben, buy or sell for WiseTech?
It's another sell. I will preface it by saying that when I sent you the list the other day, that was before that announcement of the board rollover. So it's gone sort of from bad to worse for WiseTech. They are a dominant logistics software provider. Historically, they've acquired a lot of smaller players and bolted them on into their CargoWise platform. Yeah, dominant market share in a growth industry, sticky software, good customers. It all sounds pretty positive. But there's a couple of things similar to Seek in that sense that have kind of turned us away from it. One is the governance concerns. We've seen the founder Richard White has been put under the microscope in the media for kind of his behaviour and governance within the company. I'll leave listeners to do their own homework on that. But yeah, it does raise these question marks, and especially when we've seen the board has had a bit of a disagreement with them. Four board of directors have stood down, and Richard White, the founder, is going back into the chair role. So it's founder-led businesses are often seen as a giant green flag until the founder kind of wants to run the show their own way, and then you're kind of behind to what they want to do with the company. So too much risk in it for us here. We think the acquisitive growth kind of masks what's probably not that great underlying organic growth, and you're paying 86 times estimated earnings PE for it. So too expensive for us.
Too expensive. I mean, I guess the flip side of looking at something like this would be that, there's all that sort of executive trouble, and so then the stock gets beaten down. So you're not thinking of it as a buying opportunity here while it is sort of taking a hit. There's enough reason there to say it's still a sell.
I think so. I mean, we do look at these things, dynamically and change our minds sometimes. Like a Megaport is a good example of one where we did change our minds. But I mean, WiseTech, we thought it was overvalued at 120.
Yeah.
At 94, it's still not enough bad news in the price for us to really look at buying. But yeah, always updating our views. Still a sell.
Still a sell. All right. WiseTech's a sell. All right, next we've got Energy One Limited, ASX EOL, currently trading at $11. EOL in the IT game stands for end of life. Is there still life in Energy One, Ben?
We think there's plenty of life left in Energy One. Energy One Limited, it's a small little software business based out of Sydney, which does energy trading and energy markets software and solutions.
I should also mention that the day before we recorded this jumped 18%. So the quote I gave, which is $11. So when you sent me your list through, a bit like the WiseTech story, you sent me the list through and then everything changed. You sent me a list through and this jumped 18%. So
it did have a really good result. And it's probably not one that people have heard of, which is why I kind of threw it in here. I think it's a really interesting little company. We own it in the Seneca Australian Small Companies Fund. And yeah, it's one of these ones where, again, the theme is inflecting profitability. So basically these guys do, if you think about a new wind farm and they need to plug into the grid and they've got to sell their energy and do all that kind of regulatory and operational side of things. It's not as simple as just plugging it in and off it goes to the grid and you just get paid for it. So Energy One's kind of the bridge between the actual infrastructure, renewable or otherwise, gas, whatever it is, and actually getting paid for that and managing it, especially when there's periods of volatility and you can kind of sell it when it's high and not do it when it's low. So
I like that, because that's like an pure energy play then, to kind of go, well, look, because the green energy has this big hype sort of cycle that it goes through, and everything's going green, and then kind of coal and fossil fuels come back into vogue, and there's a big push probably from the coal and fossil fuel producers. But yeah, I guess these guys are sitting in the middle and just kind of handling the delivery of the energy, so the governance of the energy. So then they're winning either way.
Exactly. So
assuming they're doing a good job.
Yeah, and I think they do benefit from that increasing fragmentation of the market, which is primarily driven by renewables. But yeah, it's a good company. Management owns a lot of shares, so it's not super liquid to trade. But yeah, dominant market share here in Australia, slightly less dominant market share in Europe, which is kind of the growth market. And they've been doing some investing, and yeah, that money's now spent, and ARR's recurring revenue is growing at 10 to 15 to 20%, earnings up 40, 50%. So great operating leverage. And these software companies, as they grow larger into the WiseTechs and the Seeks of the world, they do get a valuation multiple re-rate. So that's kind of the thesis for these guys.
Great. All right. Energy One is a buy. And with that, we're going to take a break here, grab a word from this week's sponsors. Hey, if you've got a stock that you want to hear about on the show, let me know. You can use the contact form at equitymates.com or flick me an email, contact@equitymates.com. We'll be right back with more buy or sell right after this.
And the old bear is back.
I'd buy that for $1.
Welcome back. You're listening to Buy or Sell on Equity Mates. My expert today is Ben Richards, investment analyst at Seneca Financial Solutions. Ben, we're back with another 5 stocks. We're going to kick it off with the basically the top 20 companies in Australia. We're going to look at the iShares S&P ASX 20 ETF, ASX ILC, currently $31.41. It's Australia's top 20 companies, just like the Australian Idol top 20. Some are performing better than others. Where are we at with this, Ben? Buy or sell?
Yeah, it's a sell for me, for us, Adam. I threw this one in there as a bit of a rogue one.
Yeah, I like it.
A collection of companies rather than just one. But, when I look at the market as a whole, I believe that the ASX 20 is the most overvalued part of the market for what you're getting. Yeah, it comprises 60% of the ASX 200. So the top 10% of companies comprise 60% of the value of the major index. So if you're buying any kind of ETF, that's just something to beware of, that really getting a lot of exposure to the top 20. And the top 20 is dominated by the big four banks, CommBank, Westpac, ANZ, NAB, and the large iron ore miners, and a few others like your Goodman Groups and supermarkets, your WiseTechs. And yeah, we just look at the banks and think that relative to history, they look really expensive and they've delivered quite low growth. So the expected return from here, I know they've done well recently, but from here looks quite modest. And iron ore, you're obviously getting a lot of exposure to Chinese demand for steel, which has been quite weak. So, yeah, in general, we just see that area of the market as less attractive. And if we're fishing within even the ASX 200, we're kind of seeing more opportunities below the surface there.
Yeah, and with Chinese warships just kind of floating around Hobart and thereabouts, I'm not sure what the future holds, to be honest.
I've got mates sending me links on different websites. I'm trying to focus on work. I don't need to think about any of this more serious stuff.
Very good. All right, so that's a sell for ASX, for ILC. Sell. All right, next up, we're going to look at AIC Mines Limited, ASX A1M, currently trading at 41 cents. And Ben, I was tucked up in bed last night just scrolling through industryqueensland.com.au, and I saw that AIC Mines has found some high-grade intercepts at their Jericho site. Good news?
Good news, and pleased to see you on the Industry Queensland page.
Mate, I don't go, that's top of my feed, mate. I'm there every day.
That's some
daily.
Serious due diligence. Deep in the weeds, but good to hear. It's a really cool under-the-radar copper producer. The reasons why copper is interesting to investors is it's kind of the central metal when it comes to electrification and decarbonisation. It's in things like copper wiring, which is, energy transmission, and a lot of electric vehicles have, 2 or 3 times the copper that a petrol vehicle would have. So it's got some pretty good demand growth, whereas the supply is quite constrained. And on that note, on the ASX, if you're looking to invest in a copper producer, you don't have that many options. The largest players outside of like a BHP and a Rio do have some exposure, but it's quite small relative to their iron ore, which is the main game. You're kind of looking at a Sandfire or a MAC, Metals Acquisition Corp. Sandfire is expensive. MAC is good asset, but doesn't really make a lot of money after they did that deal with Glencore to buy it off them. And after paying royalties and all this sort of stuff, they don't actually make that much. There's nothing left on the bottom line. And then you're looking at, 29 Metals and Aeris AIS, and they're both kind of marginal, lower quality assets, which is all a long-winded way of saying that AIC Mines is the standout small cap copper play. It has a producing mine in Queensland, which is why it's...
familiar with them at Jericho, I believe.
Well, their cornerstone asset is Eloise, which does 12,500 tonnes of copper. And Jericho is this project they've acquired basically right next door, which will take production up to 20,000 tonnes per annum, which is pretty reasonable. And the key thing about Jericho is it's actually all shallow, near-surface copper mineralisation. So it's quite low cost to extract compared to Eloise, which has been producing for decades and is quite deep at this point. So it's relatively high cost because you've got to put ventilation shafts down and truck it up, hundreds of metres to get it back to surface and to the processing plant. So we think this could be a step change in production costs and, production in general. It's got good leverage to the copper price and really sensible management. Aaron Colleran basically took Evolution Mining, EVN, from a company earning $50 million to $380 million through a combination of acquisitions and some organic growth. So him and team have done it before, and this is, a small copper playbook in Queensland, which is a good place to be.
All right, love it. AIC Mines is a buy.
I think I'm going to buy.
Next, we're going to look at Guzman y Gomez Limited, ASX GYG, currently trading at $34.97. I see they're struggling to break into the US market despite offering bigger burritos, Ben.
Yeah.
If supersizing your servings doesn't work in the US, then what's your backup plan?
I mean, I look at this company as trying to sell ice to the Eskimos when you're talking about, fast food Mexican into the US market.
Because there's a lot there, right?
In terms of Mexican food, like I actually spent a little bit of time in California many years ago.
Yeah.
And huge Mexican cuisine there. So I just don't think that it's the market is super ripe for a new offshore entrant.
Although Trump's new tariffs into Mexico could push up the price of jalapenos and other Mexican fare.
It's not for us. It IPO'd recently and it's done really well. The share price doubled from its IPO.
Yeah.
Which would make you think this business is absolutely flying. I would caution investors, though, that a lot of that was due to a tight float, so they didn't actually offer much new stock to the public when they IPO'd.
Oh, yeah.
Yeah, a lot of existing shareholders that were funds that took stock pre-IPO came out and supported it on market with their listed funds. So read between the lines as to what I'm saying there, but they were obviously supportive on market. And it's beneficial for both their pre-IPO fund and their listed equities fund. So I just caution that aspect of it, as well as the valuation, 150 times PE for a Mexican fast food restaurant. It's got to have a pretty strong growth trajectory to be able to grow into that valuation. And if you look at, Domino's Pizza selling cheap pizza in Japan, they've just shut up shop, closing stores there. Like, that's been a bit of a disaster. Yeah, I think the other key catalyst, and I'm going to call it a big short style catalyst, is there's a bit of escrowed stock coming out from insiders, which is available to be sold upon the release of the half-year result, which they've just released. But the majority comes out after the full-year result in August. So put it in your calendars in August. In some period, maybe 6 to 12 months following that, we're expecting to see some pretty significant insider selling, which is generally, pretty negative for the share price. So at this price, it's a sell.
All right, I'm going to put it in the calendar to get you back on the show, and we can just see what happens. How about that? Love it though. Excellent. We talked about on Comedian versus Economist podcast the other day that we've actually hit peak McDonald's in terms of store numbers. So across the US, there's no more McDonald's opening. So I don't know whether there's just a general trend also away from fast food to more sort of healthier options or whatever it might be. So those conditions might make it tough to launch a bunch of new restaurants as well.
Yeah, I mean, it's not an infinitely sized market. KFC is struggling to grow. Like, Australia's mature, so they're trying to, do stores in Europe. And Guzman y Gomez, like, there's a shop on every street corner, it seems like, especially Melbourne and Sydney. So, yeah, I mean, remains to be seen. But
all right, we'll see. Guzman y Gomez is a sell. Next, we're looking at Antipa Minerals Limited, ASX AZY, currently trading at a princely sum of 4 cents. Antipa Minerals looking for another gold rush, and why not? Gold is on a tear. Where are we at with Antipa, buy or sell?
It's a buy. If you're looking at gold companies, you can either look at the producers or the explorers, or the bit in the middle there is the developers that have existing gold deposit projects that they own and will either try and develop them themselves or sell them to a larger miner who can more easily get them into production. And a lot of these developers sell a good story. It's a great project. We think, big companies will be interested in it, blah, blah, blah. And most don't make it. However, Antipa Minerals, AZY, it's a high conviction pick. We've profiled it on Livewire and for our Good Research subscribers, which is a limited subscription research service. And I'll briefly outline the thesis and why it's so exciting. It's Telfer was a mine owned by Newmont, which they've just divested to a company called Greatland Gold, which is listed in London currently, but imminently will be listing in Australia on the ASX. And Telfer is massive. It's a mill that's the third biggest in Australia, which you think is a pretty big gold mining jurisdiction. And it's historically mined 500,000 ounces. Like, it's a huge mine, but it's come to its end of its life. Newcrest merged with Newmont, and these small assets that don't have any mine life, they don't care about. So they flicked it off to this company called Greatland. Now, Greatland has this Telfer mill, which is huge, and nothing to put through it, essentially. Or they've got a year or two of production that they can put through it, and then they've got this other development project which will fill up part of it called Haverion. But Antipa has a huge land package in that area with a 2.3 million ounce gold deposit. Again, put this one on your calendar because in the next 6 to 12 months, we think Greatland needs to acquire Antipa to secure its long-term mine life. I believe Bryce of Equity Mates fame has also put it in his $500 to $5,000 challenge.
Yeah. That's going on at the moment.
Absolutely banging the table on him to pick Antipa, and we've talked about some other opportunities, but yeah, so that's where that's come from. Yeah, caught up with management recently, and yeah, feeling really positive on this. It's currently trading just at consolidation, so it's trading about 36 cents. We think any deals would have to be 50, 60 cents plus, even up to sort of 10 or $1 under the new price would be accretive to Greatland. So yeah, pretty positive on that one.
I get the sense you're trying to contain your excitement here, Ben. You've got this kind of giddy vibe coming through. That's sort of you're trying to measure it. You're trying to stay professional and deliver just a measured proposal. But I can tell that you're a little bit excited.
I've got to rein it in. I don't want people out there thinking I'm too one-eyed. Always a balanced view.
Excellent. All right, we're going to leave it there as a buy. Antipa Minerals is a buy.
I think I'm going to buy it. Let's go!
All right, the last call for the day. We're looking at Megaport Limited, ASX MP1, currently trading at $11.37. Mega, make everything great again. Big promise. Ben, Megaport, where are we at with Megaport, buy or sell?
Okay, so we used to be really big skeptics of Megaport and have never owned it.
Yep.
You know, it went from $5 to $15, all the way back to $7. And yeah, we finally pulled the trigger probably a few months back now and bought some shares in Megaport at about $7, $8 per share. And the reason was that we thought a lot of bad news was in the share price. The growth tailwinds are still there. So Megaport does data center connections. It's somewhat of a complex business, but you can probably think about it like it's an internet fast lane. So
yeah, it's a private pipe. It's kind of a private pipe between businesses. Kind of keeps your traffic off the main internet and a bit more secure. You've got a bit more high bandwidth, dedicated resources, that sort of thing.
Like that description. It seems like you've been doing plenty of due diligence this month.
I may have dabbled in the IT space, Ben. Just here and there.
It's a really good solution, and it seems like they've got pretty minimal competition. I mean, there is competition, but I think they actually just poached some staff off a competitor, is word on the ground there. But they've kind of hit this point, and I probably sound like a broken record saying this, but inflecting profitability. So previously Megaport was growing revenue, but the cash furnace. And yeah, the last year or so, they've really proven that they can be a profitable, sustainable, growing business. And yeah, market's kind of been caught up in this short-term sentiment-driven sell-off, which is net revenue retention. I think that was the key metric. So as soon as they showed a bit of weakness in that, I think the market and analysts and fundies thought this is D-Day. It's, customers are spending less, existing customers are spending less with Megaport than they were before. Management actually explained it quite well. And yeah, so we kind of grew comfortable with that. And yeah, they just reported last week, I think it was, had a really strong print. It's showing that, the trajectory over the next couple of years now can be quite a profitable ascent. And yeah, I think that net revenue retention and a couple of those other key metrics that people are focused on are starting to show some green shoots. And even at, $11, the market's probably underestimating that opportunity. Brokers are upgrading their price targets from $9 and $10 to like $12 and $14. We think that's probably fair. If you could if the share price got to that level, you'd maybe take some out. But for now, yeah, it's a buy for us.
It's a buy.
I think I'm going to buy it.
All right. Well, that's it. That's a great place to finish. Ben, thank you so much for joining us here at Equity Mates for buy or sell. If people are looking for you, where can they find you or more information about Seneca?
Yeah, Seneca, if you Google us, we did plenty of, shouting from the hilltops. But many of you might have seen Luke Larrative, who I work quite closely with on, the Equity Mates show.
Yeah, he was on not long ago, actually.
Yeah, so easiest to go through him, or I'm on LinkedIn, and shouldn't be too hard to find me. But yeah, Adam, absolute privilege to be on the show. A lot of fun.
Oh, mate, thank you for coming in. Really appreciate it. Don't forget, you can catch me on Comedian versus Economist, which is back in your podcast feed every Wednesday. Other than that, that's it for us here. I hope you'll join me again next time on Buy or Sell. Until then, it's bye for now.